Hey everybody, it's Chuck Barone. It is Monday, October the 2nd, 2023. We're in the home stretch of this year, guys. Fourth quarter, third quarter in the books. Another week of crazy. We're already off and running, man. But before I get rolling, I'm going to take a second and welcome everybody to the show. And as always, thank you guys for your support, man. You guys watching these videos every day means the world to us. Thank you guys. We'll do the best we can for you guys. All right, so let's talk about these markets today. Now, we know we got some data coming this week that we're looking forward to seeing. But right now, the market basically holding its breath, trying to figure out what in the heck is next from the Fed. Starting to get really nervous that this higher, longer thing might actually happen. And the market just finally coming around to what I've been telling you guys, man. This era of free money is over. Rates, even when they come back down, which they will, some, they're not going back down to where they were, guys. We're not going to see these zeros anymore. Just that's over now. And the result of that zeros for so long is the inflation and the pain we're feeling for it now. The idea we're going to get rid of it with just a flick of the wrist is just, I doubt it. And it's been now 18 months and counting. And here we sit with Fed funds rate at 5.35%. Obviously looking like it's going to go up. We got a bond market in tatters, a stock market teetering, wondering which the hell's next. A dollar climbing, metals down, oil spike, just the craziest market all over the place. Then you add in all these extraordinary things happening. It makes it a tough time to be doing well in investing. All right, so let's look at the markets today. Stock market, Dow falling 74 points, uncertainty and fear of high rates, 33,433. The S&P basically unchanged. It was up, but less than 1 point, sitting at 4,288 in the S&P. The Nasdaq actually pulls out a gain today, up 88 points, 13,307. So basically you have the narrower market down, the broader market basically unchanged, and the more speculative, tech stuff and biopharmacy and biotech stuff, that up today. Bond market continuing its swoon, tanking, rates spiking again today. The 10-year jumping 11 basis points, 4.68% on a 10-year. 2-year, 5.11%, up 6 basis points. So the longer-term rates climbing a little faster now than the short-term rates are. The inversion narrowing, so now you got only 43 basis points between them. This is telling us, kind of telegraphing where things are going to go when rates get out of this inversion. You're going to see a 10-year yield that's going to shock some people. Tough time right now in bonds. If you're holding long-term bonds and with short rates and you're taking big losses, you're going to wait a long time to get made whole on those bonds. Likely have to hold them to maturity to make your principal back. The dollar today up again, man. The dollar hot over 107 on the index. Last I saw sitting at 107 exactly. The dollar's the king of the hill on currencies right now, and super strong. It's kind of making things a little bit weird now. It's not supposed to be climbing like this, but I guess the dollar anticipating higher for longer for real, as a result strengthening. Now the strong dollar wreaking havoc with gold and silver, though, both having a very difficult day today. Gold falling $21.30, sitting at $1,827.10 for an ounce of gold. Silver falling $1.15 today. That's a pretty big loss, sitting at $21.02 for an ounce of silver. On my mind, this might be a little bit of a buying opportunity for silver. I like it at that. If I could get silver around 20 bucks, I'll probably scoop a little bit up. When the dollar comes back down, and it will. It was just at 102. So this is a pretty steep climb for the dollar. We'll see how long this can hold. When the dollar comes back down, metals will rally back up. So fear not, guys. Oil today, in spite of its giant spike, falling down $2.02, sitting at $88.77 for a barrel of West Texas Intermediate. Still a super high price, and as a result, everybody paying the price at the gas pumps. I mentioned last week that here in Vegas, over $5 per gallon for regular, and everybody around the country, around the world actually, responding with the prices they're paying. And I thought we had it tough here in Vegas. Not as tough as some other places. All right, so as we do every Monday, let's look at what we're going to be dealing with this week as far as the data we're going to get released, when, and how it could affect markets. Today we got a couple of little pieces of business. Construction spending up. The ISM manufacturing index up just very, very small. Manufacturing having a tough time today. Might actually be in recession, but as it is right now, the manufacturing index has a small climb. Tomorrow we will get no news, so tomorrow will be a quiet day. Maybe a day where we'll hear from some Fed people. Usually they fill the void in with some talking. On Wednesday, we'll get factory orders, which are expected to be up. Yay, factories. And we're going to get the mortgage bankers indexes, and those are expected to be down pretty dramatically. Thursday starts the fun. Okay, so Thursday we're going to get jobless claims, and that's a high one there for the day. They're expecting 209,000 this week versus 204 last week. They keep lowering the number, guys. The Fed needs 285 to be job gain neutral. 209, well, that's not a number the Fed is liking. As we know, they're hating these job gains. They feel like these are the big impetus, the big push on inflation right now, wage gains, hot jobs market. So let's see where those come on Thursday. We'll also get the trade deficit surplus this month. Holy crap, we're going to actually have a surplus in our trade deficit. And we're also going to get information from Freddie Mac on mortgage rates. And it's expected to show the 30-year mortgage now averaging 7.31%. I gotta say, man, I can't believe rates are that high and real estate is still climbing. That's astounding to me. I thought property values would have come down pretty dramatically. By now, they have not and are not going to. So this number, tough for real estate. Friday, we'll get non-farm payrolls, which is also known as the jobs. How many jobs did we create in the month of September? They're expecting 170,000 versus 187,000 in August. We'll see. They've been underestimating this for pretty much consistently all year, so we'll see where that comes in. We're also expected to see unemployment numbers drop from 3.8% to 3.7%. And also on Friday, we will get consumer credit numbers. And consumer credit is expected to have risen $11.7 billion last month. So consumers just binging $22 billion in the last 2 months, if that number comes in correctly. Wow. Good. God bless America, man. I'm glad to say that of that $22 billion in new consumer debt, none of it is mine. Yay, Chuck. All right, so let's talk about a couple of things before we go today. A couple interesting things I saw. Residential real estate prices hitting new highs. Prices going up everywhere. Vegas median price here in Las Vegas now over $450,000. So it's approaching the peak again. And the prices, especially when you have rates this high, I'll tell you guys, ordinarily in a normal market, prices would be coming down. But because of this fake bullshit 0% interest rates, so many people are locked into mortgages in the high 2s and low 3%. They're never giving those mortgages up to trade for a 7%. Even if you buy you trade your house for a substantially smaller one, and you give up your 3 for a 7.3, your payment's going up dramatically. No one is going for that. So as a result, very little existing housing on the market. driving buyers to new builds, which are driving the prices up there like crazy, which in turn drag up prices on existing. And existing housing, because there's so little of it for sale, very, very competitive, especially at the bottom of the market. People are now getting multiple offers. Again, offers over appraised value, just the stupidest, craziest stuff. And this is all artificial. This is all done because of the machinations of a few knuckleheads in government, man. Sad, really sad. Student loan repayments kicking in today, starting back up. So the people with student debt who've had pretty much since the pandemic started back in 2020 have had a free pass on making payments. Well, now those payments starting back up, big fears on how that's going to impact the economy. I don't know how much it's going to really be such a massive big deal on it, but it's certainly going to hurt consumers, especially the people that have to make those freaking payments. Now, one little thing though, more than 800 billion, I guess, or 800 million, can't remember the numbers exactly, but Biden has already, 800 million, I think, has already forgiven debt of people who've been making payments on their student loan debt for so long. This new Biden debt forgiveness plan. So a lot of borrowers, more than 800,000 borrowers, that's what it is, have had their debt retired. So at least there's a little bit of relief for student loans there, but the only people that are getting that relief, I guess, are people that have been making payments for up to 20 years or something of that nature. So it's pretty limited in who's getting dropped. 800K, that's a lot, seems like a big number to me, but apparently there's millions and millions and millions of people in this country with student loan debt. Another interesting thing I saw today, the Federal Reserve, our buddies, St. Jerome and all of his friends, are literally just bleeding cash. I was reading this. These are their own numbers. Their mark-to-market losses on the paper they're holding in their portfolio now topping $1 trillion. So if they actually had to mark the assets they're holding to market, they're $1 trillion down. Here's the real shocker, though. Actual cash losses over the last 12 months now totaling over $100 billion. And these are not paper losses like the bonds they're holding. These are actual cash losses. So the Fed, good thing they can print up the money because they're certainly losing it pretty quick. And finally, Jamie Dimon, our buddy from JP Morgan Chase, warning the world to prepare for a 7% Fed funds rate. Apparently, Dimon believes that they're not going to get inflation down to their target number without a rate that high. Warning people to prepare for the worst. Not guaranteeing it's going to happen, but saying, you need to prepare for this, And then you have the Fed, a couple of Fed people out, Bowman, Neil Cash and Carey, and a few others, talking up higher and higher rates as well. Wow, could you imagine what the world would be like with a 7% Fed funds rate, man? Holy crap, I can't tell you right now, that would guarantee a very tough recession, man. Anyway, guys, that's it for the day. We'll be back again tomorrow. Tomorrow's going to be an interesting day. We'll try to find something interesting to bring for you guys because we're not going to have a lot of news to talk about. We also have a lot of political crap that I'm not going anywhere near. But we'll bring you guys the stuff you need. Right now, everybody just kind of take a breath. The week's starting a little slow, but toward the end of the week, I'm sure we're going to be rolling with whatever the new mania of the week is going to be this week. Anyway, guys, that's it for the day. As always, we appreciate your support. I'll be back again to bring you guys the news you need tomorrow. Until then, take care, guys. Thanks.